One of the most asked questions we get on Instagram and YouTube is when prices on the secondary market will stop falling. It might also be phrased as, is now a good time to buy X, Y, or Z, or have we hit the bottom? At this point, it feels like we've been talking forever about how prices just trend lower and lower every month, but when will that stop? How close are we to the bottom? So we thought in this video we would just address the question head on. But just before we get into that, if you have other questions that you would like us to address in future videos on this channel, please let us know in the comments below. You can also reach out to us on Instagram or through our website. Details are in the video description. Obviously, we don't have a crystal ball and we're not going to tell you, okay, we think that the market is going to stop falling on a given day or even a given month. There are a variety of both micro and macroeconomic factors to consider, and obviously any change in those factors could result in a change in how far prices fall and for how much longer. We can answer the question using the data we have, and I think the two most important questions to focus on are, first of all, how did the market get into the state that it's in today? And the second is, what metrics can we use to assess how healthy the market is today? Rolex prices have now been declining for 20 months, and they've dropped over 30% since their peak, as given by our Rolex Market Index, which tracks the performance of 30 of the most highly traded watches on the secondary market based on annual transaction value. This index is rebalanced once a year, and the inception of the index is January 2017. So what we can see when we look at the roughly 6-year history of the Rolex Market Index is there's sort of three distinct phases. First, we have this relatively steady growth from the inception of the index to about 2019. This is when online media and the growth of online sales for luxury watches was really starting to take off, turbocharged by events such as the record-setting auction of the Paul Newman Daytona in 2017, or the introduction of uber popular models like the Tudor Black Bay 58 in 2018. Then, in early 2020, COVID hit, and suddenly prices started going up at an ever faster rate than we had seen prior to that. People were cooped up and couldn't spend money on vacations and other things they might have in an ordinary year. All of a sudden, with government stimulus, especially in the US, people had access to all of this extra cash they started throwing around at alternative assets. Crypto was a part of the same sort of, speculative bubble. People bought into the idea that they could, quote unquote, invest in a watch and flip it later, or even immediately, because of a belief that prices would just keep rising. But alongside that, for enthusiasts and collectors, these years proved to be the culmination of a longer-term trend of steadily increasing popularity for hot watches, not just from Rolex, like the Daytona, Submariner, Skydweller, or GMT Master, but also from Patek Philippe and Audemars Piguet, and several other brands. It was not uncommon for waiting lists in this time to be years long for even the most basic references in the Nautilus, Aquanaut, Royal Oak, or Royal Oak offshore families. Who wouldn't think twice about buying a Daytona at retail for around $13,000 at the time, if you could because you had a good relationship with your AD, or it was just your turn on the waiting list, or you had the cash, and flipping it for $30,000 the moment you walked out the door? Or even buying it at $30,000 in the hopes of flipping it at $40,000 or even $50,000, given that secondary market prices only ever seem to go up, with brands either unable or unwilling to ramp up supply to meet all of that demand. And so we come to the third phase beginning in March 2022 when the music finally stopped. As I mentioned before, we're now 20 months into a near continuous decline that has shaved over 30% of the index off its market peak. We have not hit an inflection point where we can see prices stabilizing, let alone starting to rise again. But why did the rise in prices stop in the first place back in March 2022? We believe that given a base of true collectors, enthusiasts, people that are buying watches to wear them, there's only a certain amount of speculation that the market is able to support before things start becoming unsustainable. And at the same time, we also see that the decrease in secondary market prices coincides with the decrease in prices for a lot of other so-called alternative assets. It coincides with this increase in interest rates, at least in the US, which makes the opportunity cost of holding such assets higher. So our belief is that around this time due to these factors, the market reached a tipping point. It was no longer able to support the level of speculation that was taking place. There were only so many suckers willing or even able to buy steel Daytonas for over $50,000. And so since then, we have seen a mass exodus of speculators, which has caused prices to fall. And that's the high-level story of maybe how we've arrived today in November 2023. Now let's tackle the second important question I asked at the beginning. How do we assess the health of the market? I think we can present three factors that might give a high-level understanding. The first factor is the age of inventory on the market. Just how long is product sitting on the market that's available to buy today? We can see that we're at a 3-year high for the median age of inventory for watches. So that's half of watches that are available to buy today have been sitting around for 100 days or longer. The second is the total supply on the market. How much inventory is there out there to buy, available to buy? In the Rolex index, we are also near a 3-year high for the amount of inventory for these 30 most desirable Rolex watches. So it's not that these watches aren't available to buy. These are in-demand GMT Master and Daytona and Submariner and Yacht Master references. And there are twice as many of them on the secondary market available for purchase today as there were at the start of 2021 or even at the start of 2022. And the third is something that can be simply understood as turnover rate. We call it the absorption rate, but basically how much inventory is being turned over, how much inventory is being consumed every month relative to the amount of supply on the market. And the absorption rate is near a 3-year low. You can see that it's significantly lower than it was around 2021, where roughly there was a 30% turnover every month. This peaked at the height of the market in January 2022. We estimated that about 40% of the inventory of the market turned over at that time. So, just a lot of people buying watches. And then since the downturn, we're now at, like I said, around 20%, which is near the 3-year low. So let's think about these metrics and the performance of the market in terms of maybe how far along chronologically we are into this market downturn, and then how far along price-wise, performance-wise we are in terms of the downturn. So all three of these metrics show that basically if you were to approximate or if you were to equate these metrics to the health of the market, that the market is really quite unhealthy right now. We're at or near 3-year highs for total supply and age of inventory, and near a 3-year low for turnover rate. So basically, there's still a lot of extra supply in the market, which was dumped by speculators or people who are just maybe not interested in watches anymore after the prices started falling. I think it's quite feasible that the amount of time left until we reach the end of the tunnel is measured in months, maybe even years. I think it would surprise us, certainly, to see a consistent, steady increase or even stabilization of prices given where we're at in terms of these market health indicators compared to historical trends. But then the second question is, given that we've already dropped 30%, is it likely that prices could drop another 30%? That would seem unlikely. We're more than halfway along in terms of, the price decline that we will probably see by the time we hit the inflection point. I think we saw the greatest volatility in the market in the months leading up to and right after prices started falling. And since then, the rate of decline has been much more gradual. Currently, Rolex prices are about 10% higher based on our index than they were 3 years ago. That's not even good enough to beat inflation in this time period. But still, the most desirable models, the GMT Masters, the Daytona, at least all of the ones that are in steel, still command significant premiums over retail. There are still plenty of Rolex models that you can buy below retail, but many of the precious metal references, a lot of the two-tone references are below retail. Even some of the stainless steel models from the Sea Dweller or the Yacht Master collection, which are not as desirable as some of the other ones I mentioned earlier. So if we think about retail prices sort of as this base, it doesn't necessarily mean that there will be no more speculation, the moment prices fall below retail. But if we think about it as a sort of baseline, then realistically, watches like the stainless steel Submariner or the stainless steel GMT Master, which trade right now for 20 to 30% above retail, realistically, we're not going to see them fall thousands and thousands of dollars below their retail prices. I think they could approach the retail prices, but for prices to fall for another 30% from where they are is perhaps not so realistic. We can expect the rate of decline to be more gradual as we approach the bottom, although it's not immediately obvious from the data that that's happening yet either. What all this means ultimately for collectors and enthusiasts like ourselves, and hopefully for everybody watching, is that if the question you have on your mind is now a good time to buy, it would seem that certainly for the watches that we track in the index, and therefore Rolex generally, we may be at 3-year or close to 3-year lows, but it doesn't look like we're done with price declines. Let me know if you agree or disagree with this analysis, what other factors you think might be beneficial in assessing the health of the market and therefore making some sort of prognostication about where we might go. Leave your thoughts in the comments below, and we hope you found this insightful, enlightening, maybe even entertaining. Thanks for watching.